welcome to a special live edition of Making Sense where we say no to panic, but yes to preparation. Look, it all kicked off over the weekend when the US bombed Iran's nuclear facilities. Iran fired back. And while the very first, of course, important thing to check was the human impact, there was also those very real financial impacts that also impact upon many people. Oil prices, KiwiSaver balances, inflation risks rising again, just when we were hoping for some breathing room. Now, there is a ceasefire for now. Very grateful for that. But it is also extremely delicate. And frankly, this situation has brought more attention to the wider tension in the Middle East currently. So, what happens next? And importantly, how does it affect you? Should our plans include strategies to get through these types of crises? Should you be doing anything? Or do you need to just play possum through this and not do anything at all? Look, we've brought together powerhouse panel for a live edition of Making Sense. We're going to cut through the fear, cut through those headlines, the noise, and we are going to get some answers instead. Now, we're going to try to fit in your questions as much as we can throughout this session as well. So drop those into the chat as we go. Let's make the most of being live together. And if at any point you do need to leave this live session, don't worry. The replay will be available on the Making Sense podcast. So hit subscribe wherever works for you, Spotify, Apple Podcasts, YouTube, other, and then you can come back to this, get all of those good insights on your own time as well. Now, before we properly get into this, it is really important that we do have a disclaimer. This is not and can't be individual financial advice. Everything we talk about here is general information, and from there, you'll need to adapt it to your own financial situation. If you would like someone to give you individual financial advice, a financial advisor, always the best bet. What we'll be doing here is general information. So, on that note, let's bring in our wonderful panel of experts. First up, we do have Jarrod Kerr. He is the chief economist at Kiwibank. We also have Michael Gorin. He is a wealth advisor with AdviceFirst. And last, never least, Gareth Kiernan. He is the chief forecaster at Infometrics. Thank you all so much for taking the time to come in here. Your expertise, it's really varied, it's really important, and so helpful for bringing some actual knowledge into this rather than just panic and speculation. Look, I'm going to whip around each of you with this first question. I'll start with you, Jarrod. When you first heard about the escalating situation with Iran, what was the first part of the financial world that you wanted to check in on, and did it react how you expected it to?
Yeah, you kind of naturally look at oil prices when things happen in the Middle East. And, we certainly saw quite a sharp spike, as investors started buying up oil in anticipation of something quite drastic happening. But then it wasn't long when the market started anticipating a ceasefire, and we saw a complete reversal in oil. And you look at some of the other assets out there, they didn't really react a great deal. We sort of unwound everything quite quickly, and we're now looking at fundamentals again, and fundamentals are soft.
Yeah, it's interesting how fast it spiked and then how fast it died down again. To me, the money world really reacted somewhat the opposite of what a lot of people had initially expected. How about, was that what you thought as well, or different? And that's to you, Jarrod.
Seizing of supply chains of oil, that scares a lot of people, and rightly so. Targeted attacks versus boots on the ground, I think, very different outcomes there. So, I think the markets reacted as you would expect, but then unwound just super quick.
What about you, Gareth? When you saw this starting to build, What did you want to check in on? Which part of the financial world? And did it react how you were expecting?
Yeah, like Jarrod, the first aspect I go and look at when you hear about the Middle East is those oil prices. And look, the direction of travel was as expected initially. When you compare it to previous sort of major episodes in the Middle East, whether there was the invasion of Iraq in 2003 or the Gulf War back in 1990, nowhere near as big in terms of the magnitude this time around. And maybe that does reflect some of the targeted nature and the fact that it hasn't sort of it didn't spread beyond what was there initially. But yeah, surprising for me, as Jarrod said, that how quickly things reversed back out. I mean, and even that spike we saw, look, it only took oil prices back to where they were in February this year before the whole tariff situation started to really escalate. So, in the context of that, the move was probably smaller than I would have expected when we've seen prices in the past, double at times with this sort of thing going on.
Yeah, absolutely. Michael, how about yourself?
I usually like to do a bit of an overview. So I'll look at futures across the board, index futures, but also commodity futures. But like Jarrod and Gareth, it's the Middle East. Light sweet crude was top of that list. And at the time when I first looked at that initial spike, but it has settled since then. Yeah.
Yeah, yeah. It was a really interesting response on this one, I thought, and potentially a real vote for how much volatility the markets have been putting up with already recently. That they react in this quite muted way, almost like another day, another conflict. Jarrod, those oil prices you mentioned, as you say, usually go up in conflict, currently down. What do you think when you're looking at it now? What are you keeping an eye on, and where do we think it might head from here?
Fundamentally, you kind of look at the oil market and say, there's actually a decent amount of supply. Like OPEC's actually increased their supply. So you think, okay, there's no issues on the supply side. If anything, it's increased a bit. And then you think about, well, what's happening with demand. And, most forecasters, IMF, OECD, World Bank, they've all revised their global growth forecast down, particularly around trade. So your demand's coming off as your supply is fine. That puts downward pressure on oil prices, if anything. But then, what are we keeping an eye out for? Well, event risk, right? So you can have a view that oil might gradually, come off in price, but as Gareth said, there's some real, event risks out there.
Well, exactly. And oil is this really big signifier because it underlies so much else, right? I mean, why is it that when we're looking at things from that financial perspective, the economy perspective, why do we go to the oil prices and what sort of knock on impacts does it have for the average person?
Oh, look, I think we look at a lot of things. So not just the oil price. The oil price gives you a pretty good indication, but you can look at copper, you can look at commodities, and in general, there's a lot of things that we track, and that it's really hard getting a handle on what's happening right now because we've seen quite a pull forward in activity in anticipation of tariffs coming on. So the data looks kind of okay in parts, but then you look at the surveys of manufacturers. A lot of those have headed into contractionary territory. So I think global growth is much weaker than it once was.
All right, Michael. Usually, again, saying about the money world reacting in interesting ways. Usually, this sort of situation, we see share markets go down. There is more than one market, of course, but many markets have gone up. Thoughts on why? Are there any in particular you thought reacted in an interesting way?
An interesting way. Well, definitely the outcome is somewhat counterintuitive considering it was quite a blockbuster. It's U.S. flying stealth bombers over Iran. Shocking to some extent. But the real sort of outcome of this is that regionally, the equity markets there bounced with the thought that it would bring a resolution to the conflict, and it has done that. And so, really, the reaction regionally of the equity markets carried through to international markets. And so, we've seen with that de-escalation of conflict there, and hopefully a lasting resolution, but at least a temporary resolution, that markets are moving on, thinking that we won't get, an escalation in the conflict there.
And there was a little bit of a push to some of the safe havens, right? We saw a little bump in gold and then it went down again.
Hmm.
I saw some people talking about maybe it would be the time to invest in stocks that are part of defense companies, or other people are talking about more defensive stocks, which is things like your power companies, companies that are always needed. When you're looking at all of these safe haven investments that can crop up at these crises times like these, did we see much of a reaction there? And even did you have clients calling you interested in them?
Yeah, that's a good question. I think because there has been so much volatility, a lot of clients are used to that. Through even COVID, inflation in 2022, Liberation Day earlier this year, there has been a lot of volatility. And so clients are getting a lot more used to that volatility on a regular basis. Because of the way that we set up client portfolios at AdviceFirst, there's a lot of resilience in the diversification we use, and clients know that, and we speak with clients about being invested for the long term, and but also appropriately to their goals and objectives. And if you have that diversification built into your portfolio, making these sort of short-term tactical moves in a portfolio, it can really be a double-edged sword, um, because as we've seen here, any sort of reaction that you made there, you would have been punished by that. I mean, if you moved out of equities and went much more defensive, there was this quick recovery, and we saw the same thing more recently too with Liberation Day, with the fear around the tariffs. I don't know if we'll talk about the taco trade today, but Trump always chickens out. He stepped back pretty quickly from, that China 140%, that's being negotiated now. But um, when it comes to more of those tactical moves, if it makes sense for an investor because maybe they have shorter term goals, sure, that's a conversation. But we're always speaking with our clients and making sure that they are invested appropriately for what they're looking to achieve.
Did you have people calling you and a bit worried? Or, as you say, there have been these rattles through the markets at various points. In the last 6 months, there's been quite a few bumps. So are people sort of learning to hold their nerve a bit, or are they still calling and saying, hey, what should we do?
Yeah, that's a good question. Generally, I would say people are holding their nerve. There are clients that are interested to know, what's happening in the market and how is that affecting their portfolio. And everybody's portfolio is slightly different, and but it is, that difference is for them, for what their objectives are. So you have that bespoke nature of the portfolios, and so they're really designed to ride out any of this short-term volatility. So having that conversation, seeing if anything's changed, if something has changed, maybe a goal or an objective, if there's a need to draw more in the short term from the portfolio, then making that adjustment. But really, when this sort of volatility occurs, staying the course is the most important thing to do. And history has shown that, in the investment world, patience is rewarded.
Yeah. Oh, absolutely. Patience can be the best tactic and also one of the hardest to enforce upon yourself, which is why it's good to work with a team sometimes. Um, Gareth, I've got to say, when I talk to people, they were just starting to breathe a bit of a sigh of relief over interest rates. And of course, there is a ceasefire right now. Brilliant. We hope that that holds. But these wider tensions and the ongoing sort of situation, do you think this could impact the OCR? Is this a possibility that it will hit interest rates?
I mean, normally for the Reserve Bank, when you've got higher oil prices, higher energy prices coming through, they will tend to look through that because they're not worried about the initial impact of higher petrol prices on the CPI or inflation. In fact, across the broader economy, that tends to suck money out of the economy because households have to pay more to fill up the car, and they've got less money to spend on other goods and services. So there's a bit of a negative demand shock that comes through there. Now that shock is not as strong as it has been in the past, say 20 or 40 years ago, because we're all driving more fuel efficient cars, and there's a lot of electric vehicles on the road as well. But it is still an impact through the economy there. The difficulty for the Reserve Bank at the moment is they are emerging from a place where they let inflation get out of control 3 or 4 years ago, and so they're still rebuilding that credibility in terms of it being an inflation fighting machine and keeping inflation within the target band. Over the top of that, you add the fact that we have had just simmering inflationary pressures coming a little bit more to the fore in late 2024, early 2025, and expectations of inflation later this year are for it pushing up. It's 2.5 at the moment, and pushing up to maybe 2.8%. Now that's still within the target band. But in that environment, the banker will be looking at it and going, okay, we just need to be a little bit careful that we don't let those expectations start to push a bit higher, and for inflation to be more of a self-reinforcing thing again, a bit like it was a few years ago. Now, we're not talking inflation going back to 7%, let's be clear. I think in that situation at the moment, the Reserve Bank, look, market expectations have been shifting away from too many more further interest rate cuts. For example, there's another review in a week or two's time in July, and expectations from the market are now that they won't be cutting the rate then. Probably still one more cut in the OCR to 3% later this year, but the sort of thought maybe down to 2.75 or 2.5%. Those expectations are being scaled back. And look, if you get those higher oil prices, much higher oil prices coming back in, it's just the sort of thing at the moment that would give the Reserve Bank pause for thought in terms of that credibility stance that they are trying to regain.
Yeah, and that is the classic. I have had so many people asking me what might happen next with mortgage rates. And of course, that can be a complex question, but it does feel like we're at the bottom of the interest rate cycle at the moment, doesn't it, Gareth? Do you think?
Yeah, you may see another 20 basis points or so coming off some of those shorter term fixed rates. I think they're currently sitting around about 5% or just under, and we see a little bit more coming through there. But what we are seeing now in terms of household behaviour is they're looking at the rates, starting with a 4 and going, you know what? Over the previous 6 months, we've been willing to float or fix for 6 months on the basis that there'll be lower rates coming. Now households are going, yeah, those 1 and 2 year rates, I'm happy to lock that in, and I might miss out on a little bit more on the downside, but gee, it gives me some certainty going forward over the next couple of years.
Yeah, Jarrod, I'll get your thoughts on that too, because that was, I asked people who were tuning into this on their questions that they wanted to know for this. And it was, I would say, a good 50% of the questions were, what does this mean for my mortgage? And should I fix, float, how long? Now, obviously, you are not a mortgage advisor sitting down with people one on one. So we do have to temper that. But, thoughts on the OCR and what's happening next? Probably.
Yeah, I mean, Gareth's right. I think the Reserve Bank has signalled that they want to feel their way through the next couple of meetings and see how inflation comes out. But even the worst forecast for inflation is that it gets up to like 3. Gareth's calling 2.8. We're around the same sort of level. That's not high. Reserve Bank should look through that. Their job is to target inflation over the medium term. We've been through a recession. Domestic inflation pressures are easing, particularly rents and other large ticket prices. So, we're of the opinion that they've done the right thing in cutting from a very restrictive stance to something close to neutral. But we're of the belief that, yeah, they do need to cut further. They do need to get to 2.5, get that interest rate in a stimulatory setting to sort of help the economy into 2026. So, our belief is they cut to 2.5 this year. That does actually feed through to a little bit more. The market's got about 2.85 priced in, which is exactly where the Reserve Bank has signalled. So it's kind of midway between a 3 and a 2.75. We think they'll drop their track again to sort of 2.5, give us that kick into next year. Because on our forecasts, when we run things through, we've got inflation falling below 2% next year. So I think they've actually got a job to do in stimulating rather than just taking things back to neutral.
Yeah, yeah, absolutely. Now, for those who are watching, don't forget you can drop in those questions. Ask us whatever is on your mind at the moment, and we will try to get that answer for you while we've got this great live session going and fabulous experts giving us their time. When we were talking about oil before, Jarrod, it's an interesting one, right? Because we do keep an eye on the oil price. It does impact so many other things. It has for such a long time been underlying so much else in the money world, where because things get shipped around the world, it impacts the price of everything else, never
Mm.
mind the rest of the impacts it can have as well. And yet, this time around, I've seen a lot of really interesting analysis that we have actually less of an oil based economy than we used to. So, even if the oil prices do go a little crazy, it might not hit as hard as it once did. What do you make of that argument?
Yeah, well, Gareth touched on it before, right? We've got a bit more clever in how we extract oil for starters, and we've got a lot more clever in how we use it. So a barrel of oil goes a lot further today than it did in the 80s, for example. But you rightly point out that it's still important. If you see a spike in the oil price, that basically touches everything, because you're transporting stuff using oil tankers, ships filled with petrol. So it does touch everything, but you're right, we are less reliant on it today than we were a number of years ago.
It's a fascinating one as we continue changing and technology gets more and more interesting in what
Mm,
it can do. Look,
mm.
let's zoom out a bit because there's a lot more that could still happen. Um, is there anything, and I'll start with you, Gareth, is there anything that you're watching for now and what sort of financial impacts it might have? So it's all sort of quieting down a bit, but what are you keeping an eye on in terms of it could have a financial impact in the future, Gareth?
Yeah, I think in terms of the way the global economy has performed this year and the sort of whole geopolitical situation, I mean, uncertainty has been such a massive theme across things over the last 6 months or so. What interested me with the recent episode is how little the VIX index, which measures sort of uncertainty and
Mm.
volatility in financial markets, that barely moved over the last couple of weeks or so. Whereas you compare it to Liberation Day, and it spiked massively. It was, I think, the third highest level it's been since the start of the 1990s. So I'm keeping an eye on that because uncertainty is still a key for me. Are the tariffs on? Are the tariffs off? It kind of doesn't matter if businesses don't know what the hell is going on because they will sort of pull back on major investment decisions, major hiring decisions, that type of thing. So uncertainty hanging over the economy for me is still a big issue. The other one from a New Zealand perspective is looking forward at the expected recovery in the New Zealand economy over the next 12 to 18 months. We've talked about interest rates and the role they're potentially playing for people with mortgages and households. The other one for me is just around the agricultural sector and provincial sector, where strength in commodity prices across the likes of dairy, meat, and horticulture is for us a key plank in terms of that recovery. Gaining momentum and continuing to improve. Those commodity prices have held up in the sort of wake of the sort of tariff situation over the last few months, but it is something we're still watching closely. We don't get necessarily a lot of data on a day-by-day basis, but one of the more timely indicators, for example, would be global dairy trade auctions. And look, they've softened a bit over the last 4 weeks or so, but still at a very good level. A bit of a canary in the mine, I think, for us, and keeping an eye on that, because if you do see those export prices for the stuff that we send overseas starting to fall away, that takes money that would have been coming into the New Zealand economy out of the equation. It stunts the recovery and signals that there's probably bigger issues at play in terms of how that global economy is expected to perform as well.
All right. What about you, Michael? What are you keeping an eye on in terms of future impacts and what that could mean for the rest of us in our back pockets?
Yeah, I think what Gareth said about uncertainty is a big factor in markets at the moment. with a lot going on geopolitically and politically as well. That creates uncertainty and volatility. And I've been telling clients that, to anticipate further volatility going forward. Markets don't like that uncertainty, but I don't see a path to, smoothing out a lot of that uncertainty in the near future. So there isn't anything particular that I'm looking out for, but I am just looking out to see what it is that's going to pop up next. And I think with Trump in the White House in the U.S. too, it seems to be his modus operandi, creating that uncertainty and using that uncertainty in negotiation. And so as long as he's there, I would expect politically out of the U.S. to be a bit of volatility.
So potentially, if you're someone who your portfolio hasn't included a lot of those safeguards, but you might need them, that if you are uncomfortable with this level of uncertainty and volatility, maybe expect that, start including that in the portfolio and the planning.
Yes and no. I think more no. There has been that volatility, but we've seen markets be very resilient. And it really is a situation where there are the Fed in the US, I would expect to get more dovish, and this is sort of going into probably Gareth and Jarrod's territory here a bit. Sorry, guys, but that certainly is going to be stimulatory for markets, with generally central banks, reserve banks, the Fed coming down in interest rates. That's stimulatory. There's a lot of deregulatory and tax cuts that will happen in the US as well. And so there's a lot of tailwinds to markets at the moment. So I think stepping back would be a mistake. I think staying invested, sticking with the plan, making sure that you're allocated appropriately for what your objectives are, whatever those might be, and you have the appropriate risk allocation is very important, but not making significant alterations to that.
Excellent. All right. Jarrod, what about you? What are you keeping an eye on in terms of what might happen next and how that might impact our back pockets?
Yeah, so obviously looking at overseas, and I look at interest rate markets. Everything comes out in interest rate markets, and interest rate curves, in the US or Europe or here at home. They give you a lot of information really quickly, and you can see how financial markets are handling the current situation. So that's what I'm sort of focused on. Definitely seeing how things are playing out offshore. We're not actually just sort of sitting here going, oh, that's bad. We've actually run that through our numbers here, weaker global growth. And it just reinforces the fact we need more stimulus from the Reserve Bank, because we have interest rate sensitive parts of our economy really struggling, and I mean really, really struggling. And the stellar part, the standout part, is the agriculture. It is that external sector, the exporters that are doing really well. But our greatest strength is also our greatest weakness, and that they're the ones that are, most exposed to the tariff war and the slowdown in global growth. So yeah, we've got a two-speed economy. We've got, Fonterra paying $10 a kg and forecasting another $10. I hope they get that forecast. That's flowing into the rural sector, which is fantastic. Great field days a couple of weeks ago. But do you know what? There are other parts of this economy related to housing, construction, that are still struggling. So yeah, I'm thinking about our most exposed sector, which is the export sector, and I'm looking at the domestic economy going, more needs to be done by policymakers here.
What would you like to see happen there if you got your wish?
I'd see, relaxing in bank capital requirements, number one, and I'd like to see, risk being sort of toned down a little bit for businesses. So risk weightings, lower those. Try and get bit more credit flowing in the economy. Obviously, interest rates lower, cutting the cash rate to 2.5. And I would have liked to have seen the government do more on infrastructure in this country. This fear we have of taking on debt is unnecessary. I think we should be taking on a bit of debt to tackle our infrastructure problems, because that's one of the biggest inhibitors of our economy. The lack of investment in infrastructure, I think, is one of the leading causes of our productivity problems. That was a bit of a rant, but thanks for letting me get it off my chest.
I like a rant anytime. Look, there's been a really good question here from Lloyd, who's watching, and it gives me thoughts for both Michael and Jarrod. So the question is, what's the best way to manage currency risk? Is it worth looking at things like hedged ETFs? If the USA defaults or the currency is debased, will this even protect us? So I'll start with you, Michael, because I think that's an interesting one. A lot of people do look to invest from New Zealand to overseas markets, and that gives you a currency risk to your investments. So at times like this, or even, to be honest, even generally, how do you manage that currency risk? Should people be looking at things like hedged options, or is it also horses for courses that it's hard to give a standard answer?
It's a great question, and I think it's timely at the moment. We were talking about this a bit earlier. The US dollar has been very strong, but we've seen that it has been coming down compared to the Kiwi dollar this year, and the general consensus is that that trend will continue. When you're looking at what you do to hedge, potentially hedge, not hedge, you have to look at that goes both ways. So for 2024 and before, US dollar was very strong. If you were unhedged to Kiwi dollar, you got the outperformance of that. And if you were unhedged, through this year, you are, that's a drag on your performance. A lot of times the answer isn't binary. It's not, go 100% hedged or go fully hedged, not hedged. It's somewhere in the middle. At the moment, I would say that definitely hedging at least a portion of your exposure is a good idea. Like I said, the general consensus is that New Zealand dollar, US dollar is weakening, and the expectation is that will continue. But Jarrod will have some good things to say about that, I'm sure.
Yeah, well, exactly. I know you do have some thoughts on this one, don't you, Jarrod? Because there has been a lot of discussion. I've seen this quite widely in various expertise, analyst sort of commentary about what's going on with the US and whether it is still sort of that financially dominant force that it once was. We saw earlier, and a couple of crises back, where the bond market in the US wasn't doing well because people didn't see it as the safe option that it once was. So do you think there's an argument that we're seeing a little bit of a change in the financial dominance of the US? Would that change, the money world, money strategies? I'd love your just general thoughts on this, Jarrod.
I think, it's a very good question, and it's one that's been asked for a while, actually. And, the US dollar is just so dominant. So about 60% of global reserves sit in dollars. And then the next largest is the euro, and that's 20%, right? So your next best option is the EU. And it was only 10 years ago that we had Brexit and people saying that the EU was going to break up. So it's not a fantastic second option either. And I think people are finding it, difficult to get out of dollars completely. And what we're seeing is a shift into gold. Fair enough, gold's taken off. We've seen a shift into Swiss francs and other safe haven currencies. We've even seen, I think, quite a rally in cryptocurrencies, for those thinking about disruptive technology and what's next for the world. But it's very hard to get out of dollars completely because you just run out of options very, very quickly. There's talk of BRICS currencies. They're down 30% in the last 5 years. Brazil, no. Russia, wrong side of the war. India, absolutely. I'd buy India all day, every day. China, okay, known quantity, but they don't have their capital markets open. And the S, I think, is South Africa, and yeah, my wife's from there. I wouldn't invest there either. So you're only really talking about the I and the C, aren't you? Which isn't a lot of fun. So we have seen, this recent bout of volatility with tariffs and everything like that. We have seen the dollar coming off, which is exactly what Trump wants. He wants to make America cheap again, and he wants that dollar down, but it's not collapsing. We are not seeing a dumping of dollars. We're seeing a diversification out of dollars, but not a dumping. And I'd go as far to say as the US, so long as they've got the greatest military in the world, will be that global superpower, will be that reserve currency, probably for the rest of my life. And I'm planning on living for a long time just to annoy my wife. So there you go.
The wife catching a few strays there. I love it. Yeah, look, that's really useful discussion there. Thank you, Lloyd, for that question. For anyone else watching, if you have questions, drop them in the chat now, because we are sort of coming towards the end of our chat. So if you've got a question, drop it in. Let's get that answered for you now. Michael, one of the things that I want to talk to you about, anyone who's listening to your accent will probably know that you were born overseas, you've worked overseas in a few different markets. How do you find it in terms of New Zealand can feel very far away from these conflicts sometimes, and yet the financial world is quite enmeshed. So when we're looking at this and you're thinking about, your time working in the US versus your time working here, is it different in how it feels working through these sorts of crisis points from New Zealand versus when you were the US? Are there different strategies from here, or is it all very similar? I'd love that perspective.
Yeah, it's a good question. I think the more interconnected the world becomes, the less there is a difference. 40 years ago, 50 years ago, there may have been different products available than here in New Zealand, but because of the sort of electronification of financial markets and the interconnectedness, those products and those strategies that are readily available in the US and other places in the world are readily available here as well. There are tax differences, and so the way you structure portfolios here might be slightly different than in the US. But ultimately, the fundamentals of investing are universal. And so I also think that people are universal in many ways in the way that we react to these crises. So, there's the same range of emotions that someone in the US would have to an extreme market event that someone here in New Zealand would have as well. And in investing, it's really important to govern the extremes of those behaviors. Fear on the one side, the thought to maybe something happens and you want to totally sell out, go to cash. There's the potential there, that, and a very likely potential that you miss out on a lot of the upside. But also watching on the top end, if the market's been running for a long time, that's not the time to go to necessarily a high growth and jump on sort of what might be the tail end of a frothy market. So governing those emotions, staying invested. Yeah, I think increasingly there are fewer differences between investing in different markets in different countries. Yeah.
Yeah, it's an interesting time, isn't it? The digital divide really changes things. Gareth, there was a little bit of talk earlier in terms of the export market. We are very much an exporting country. So how exposed are we to conflict in the Middle East? If things ramp up again, how much could it touch us, and in what sorts of ways?
Yeah, I mean, the Middle East is not a huge export market for us. I was looking at the numbers earlier today, about 4% of our exports currently going through there. But it is noteworthy that over the last year or so, it is an area the government has been looking to grow. We've negotiated free trade agreements with the UAE and the Gulf Cooperation Council, and that's a reflection of an ongoing strategy from the government to just look to diversify some of that export revenue away from China, where we're still sitting at 25%, but that is a market that's performed really well for us over the last 18 years or so, but it's an increasingly difficult one to grow further, and obviously China has its own sort of domestic economic struggles as well. So look, I mean, if you were to have a broader, more widespread conflict in the Middle East, that is going to be inhibiting some of that potential export growth. I think probably more importantly, though, it is the flow-on effects to some of our other export markets, the US, Europe, most critically China, and just how a broader conflict might affect demand for our products. Often it gets talked about with a war that it can boost economic activity, right? But it's not necessarily the same type of economic activity, and it's probably not going to be demand for the stuff that we generally make. It's metals and bombs and that sort of thing rather than milk and sheep meat. So there is potential effects that come through there. Probably the other point I'd pick up around to the sort of potential conflict as well is just more generally the rise in tensions that we've seen through the course of this year and the previous few years as well, where New Zealand, over the last 30 years, we have maintained quite a fine line down the middle of maintaining our traditional military alliances with the likes of the US, Australia, but also increasing our ties economically into, in particular, China. And, the concern for me is, depending on how some of these other conflicts, whether it's the Middle East or the Ukraine, how they pan out, what does China do going forward? There's been already a bit of tension this year in terms of the South Pacific with the Cook Islands and the agreement they've signed with China, with the Chinese boats coming down through the Tasman and having live firing exercises as well. And so just, that potentially, does New Zealand get to a position where we're forced to choose sides a little bit more going forward? And what does that mean from an economic perspective in terms of how tied in we are to China and reliant on them for our exports? So those are the sort of issues that, from a broader perspective, the conflict and the geopolitical situation is just causing me to stop and think about how things are playing out.
Yeah, absolutely. And giving a quick shout out to Joanne in the chat, who says, every time I type a question, you ask it, Francis. So thank you, which is wonderful to hear, Joanne. We are in sync. I love to hear that. Look, it's the last few minutes, right? So I'm going to whip around each of you for this one. And we're going to get back to those fundamentals of really what matters to people just trying to get through the day here. So start with you on this one, Jarrod. In terms of if someone is trying to look after themselves, trying to look after their finances, do you think there's anything that people should or shouldn't do at times like this?
I think you shouldn't jump at shadows. I think you shouldn't, I better sell all my equities just because oil's, gone up. I think we all need to have a plan and try and, stick to it. Things change, along the way, but if we're thinking more of a medium to long term, I think Warren Buffett and many others have got, all these beautiful quotes about if you just stay in it for a long period of time, you're going to do well in financial assets. And I think that's a key message. What I've been telling our customers when I'm presenting is, do you know what? I'm actually optimistic going into next year. I think there's a lot that's happening now, and there's a lot that needs to happen, like with interest rates falling further. But do you know what? I think next year is going to be a better year. The year after that's going to be a better year. So we should actually lift our heads and look to next year as being a better one.
I really hope so. I've got to say, I feel a bit burned by we were all saying survive to 25, and then it has been a tough one as well. So you reckon just hold in there a bit longer? It's still coming?
Survive till 25. Now we're here. It's, thank God I'm alive in 25. There's a few looking to thrive. Now I'm trying to come up with something clever for 26. Like,
what
we
rhymes
need a
with
quick
six?
fix, politics, what else?
We'll workshop that one for our
Can we
next
workshop
spot.
26? Yeah, thanks.
Brilliant. All right, Michael, what about you? Is there anything people should or shouldn't be doing at a time like this?
I think, those overreactions can cause a lot of damage. And so really sticking to the plan, making sure, Jarrod was talking about optimism. I think cautious optimism is how I usually approach markets. Understanding what risks are there. A lot of times, the biggest risks are the unknown unknowns, those things that aren't priced in, that come out of nowhere, and there's really no way to account for those other than having your portfolio set up so that if that happens, when it does happen, it's not going to, or at least it's not going to have a severe adverse effect. So I would caution against, big sort of overreactive moves to volatility. Like I said earlier, I anticipate, through this year, we'll get these sort of events, bumps, but the markets seem to be powering through it, and so sort of stay the course would be my advice.
Excellent. All right. And I love that we all seem to have developed a bit of a thicker skin on this. Hopefully, we can keep powering through it. What about you, Gareth? Things people should or shouldn't be doing at a time like this?
Yeah, I think for me, it's a case of reiterating what the other two guys have said. Really, I mean, you take Liberation Day. We knew that was coming. We didn't quite know how it was going to pan out, right? But markets, if you'd sold or shifted to KiwiSaver, whatever it might have been, immediately after that, you were locking in essentially a 15% drop over the previous month or so, and markets have recovered. Not all of that, but most of it. They're back up another 12%, and you will have missed that out. So as Michael said, the unknown unknowns. You don't know what's coming, and by the time the news headlines are out there, you're reacting after the event and locking in potential losses. So, I had people in that week after that, after Liberation Day, going, "Oh, what should we do? Is it over? Is it going to be worse?" And I'm like, "Well, I don't know what the answer to that is, but I know that if you switch now, there's potential for a lot of regret there." So it is about knowing what your investment horizon is, knowing what your strategy is, and ultimately staying that course.
Yeah, yeah, absolutely. Well, thank you all so much for giving us that sound advice, the expertise, the bit of analysis to, as I say, move away from panic and into preparation. Very important at a time like this. That is all we have time for, so thank you very much. Those are our wonderful panelists: Jarrod Kerr, Chief Economist at Kiwibank; Michael Gorin, Wealth Advisor with AdviceFirst; and Gareth Kiernan, Chief Forecaster at Infometrics. Thank you all so much for coming on. And of course, thank you for those who tuned in, asked their questions live. That is what makes these sessions really valuable. If this was useful to you, don't forget to hit subscribe to Making Sense. There will also be the replay on all of the usual Making Sense podcast channels. So send it to a friend who would find this useful as well. Let's get some actual information out there instead of some of the panic you can see. Until next time, have a great day.